Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Well, we have another video for you today. This might be the first time we've done back-to-back videos in over a year, and the events call for it. We are experiencing perhaps the greatest unwind in the history of the crypto space with the collapse of the FTX exchange. Today, we will review the events that unfolded over the last day since the previous time we spoke. We'll talk about market impact. We'll also touch on the CPI report that came out this morning and has the markets pumping. I've got a few things to talk about and some observations to make, so I hope you guys are comfortable. If you enjoy my content, please give this video a thumbs up and subscribe to my channel. And with that, we will dive in because there is much to say. Hey friends. It isn't typical for us to talk on back-to-back days, but these events dictate that we must. We need to review the events of yesterday, Wednesday, November 9th, and the fallout of the collapse of FTX. So many of you probably saw my video at the beginning of yesterday where I expressed serious concern about the solvency of FTX and their apparent imminent closure if they were not bought out by rival Binance. Needless to say, the buyout fell through. So what we'll do, we'll walk through the events of yesterday, much like we did in the previous video. I'll let you guys know everything that happened, how it played out in the markets, what it might mean for us going forward. And then we'll even touch on the CPI report because as hard as it is to believe, there are other things going on in the market right now besides the collapse of FTX, and they are having a role to play in price. So we have a few things to discuss, and where we will start is looking at the markets right here. We're looking at the futures markets. The bell just rang about 10 minutes ago, so the indexes themselves are trading. But the thing to really note here on the S&P, you can see this huge candle. It's already up 3% today, and this was in reaction to the CPI report this morning. We'll talk more about CPI a little bit later in the video, but right now, markets are showing strength after yesterday's utter nuclear devastation. Bitcoin is down below 17,000, and it touched as low as the middle 15s yesterday on non-futures trading. So just as we suspected for many months now, the lows were taken out from the summer, and we now find ourselves in a lower level. We're getting a bit of a bounce. There's always a reaction, particularly in bear markets when liquidity is thinner and it requires less effort to move price in either direction. You get more volatility. You get bigger moves. That's why when I see a big candle like this, I don't get really excited when we're in a bear market because I know that this is exactly the kind of thing to expect. There's fewer players, there's less friction, there's less orders interrupting the movement of price. So it takes far less effort to create a far bigger move. But we'll come back to price. We need to roll this out in pieces. And where we need to start is where we left off yesterday. So in yesterday's video, the feeling that I was expressing was concern. And also I was a little impressed with just how savagely CZ, the owner of Binance, had played this whole saga. But I also expressed that I felt like if CZ offered to buy FTX, as he did a couple of days ago, and then if he were to back out of that deal, being virtually the only entity capable and willing to save FTX, his walking away would be the worst outcome for the industry. And unfortunately, that's what we got. So following the announcement that he was going to do due diligence and decide if buying out FTX was the right thing to do, a little bit later in the day yesterday, after some rumors to this fact, they announced, we've looked into corporate due diligence, as well as latest news reports regarding mishandled customer funds and alleged US agency investigations. We have decided that we will not pursue the acquisition of FTX. Now, what did they mean about agency investigations? Well, just a little bit earlier than that, it came out that the SEC was investigating FTX. There's rumors that other agencies are also interested. Who knows what all the reasons are? We will learn more about that in the coming weeks and months. But as far as Binance was concerned, the combination of a weak balance sheet and alphabet agencies investigating their potential buyout customer, that was too much for them and they walked away. Shortly after that, the FTX website was no more. Now, this is not FTX US. If you are an American customer and you try to go to ftx.com, it will forward you to FTX US, which is technically a separate entity. They remain liquid and operational, and they're not involved in these proceedings, at least not at this phase of it. But this is a huge fucking problem, guys. It goes without saying that a bunch of people are down cosmically. Many people had their net worths, or at least large chunks of their wealth, basically confiscated in the closure of FTX and their subsequent insolvency. They have a major $8 billion hole in their balance sheet. Now, when SBF was looking for liquidity 24 and 36 hours ago, that number was only $1 billion. And then it was $5 billion. And then it was $6 billion. And now it's $8 billion. Chances are it will be in the double-digit billions before this is over with. And that is a major problem because their client funds were deposits, right? These are people who expected to be able to withdraw their money in full on demand. And that obligation was not met by FTX in any capacity. Special Situations, this is a guy I follow on Twitter. I like this account a lot. He tweeted yesterday, Sequoia marked down FTX to zero. They're one of the venture capital firms that invested in their raises last year. But that isn't even the big story. FTX bankruptcy claims, customer claims, are trading at 6 to 12 cents on the dollar. That is a 90% impairment on fucking customer deposits. That is a savage catastrophe, a disaster. No one should ever have to experience that kind of loss. And when you consider that SBF is a major donor to political campaigns, and then he tried to have a lot of friends in Washington, that kind of behavior is going to lose him those friends. You don't play around with customer deposits. That is not money that people expected you to rehypothecate into risky investments and then not to receive it back. But if this story were to get a little bit weirder, in the resulting fallout, right, in the announcement that FTX wouldn't be purchased, obviously the market began tanking. We'll look at some of the price charts here in just a moment. But then a lot of the cockroaches started to scatter. Different businesses that had exposure to Alameda or FTX started making announcements, doing damage control, and Sequoia released this letter. And this is what we were quoting a moment ago in regards to them marking their FTX holdings down to zero. But something in this letter is pretty funny, and it's right around here. It says, "We ran a rigorous diligence process at the time of our investment in FTX." They ran rigorous diligence. Well, funny enough, Sequoia on their own website has some, I guess, stories, for lack of a better word. They're posted as an article about the first time Sequoia met with SBF and the reaction to it. And if you read it, this is literally on Sequoia's website. It doesn't suggest they did much due diligence at all. This is basically a story about the people at Sequoia meeting with SBF on a Zoom call and him pitching to them his business model and his vision and why he felt that they should invest in him. And I'll just pick a couple of the nuggets out of this sequence of stories here so you can see how ridiculous this is. Suddenly, the chat window on Sequoia's side of the room lights up. "I love this founder. I'm a 10 out of 10. Yes!" exclaimed a third. What Sequoia was reacting to was the scale of SBF's vision. It wasn't a story about how we might use fintech in the future or crypto or a new kind of bank. It was a vision about the future of money itself, with a total addressable market of every person on the entire planet. "I sit 10 feet from him," says Aurora, who works at FTX, "and I walk over thinking, oh shit, that was really good." And it turns out that that fucker was playing League of Legends through the entire meeting. So he was playing League of Legends while he was presenting to Sequoia on a Zoom call, presumably looking at the camera, but playing his video game as he convinces these investors to give him millions and or billions of dollars. So he took a call from Sequoia Capital and played League of Legends the entire time while they exclaimed, "I love this guy. I'm a 10 out of 10," as he expressed a vision for a business that would serve the entire marketplace of humanity. And they bought it. Not only did they bought it, but they invested millions of dollars into his company. Millions of dollars that they have now marked to zero. This is one of the most reputable venture capital firms in the space, and they're claiming they did due diligence, but the story on their own website tells one of like some kind of fanboy mania where they really got suckered in to this snake oil salesman vision of the future and of some magical exchange that's literally going to serve all humans. So you can see how even people whose job it is to do proper research were not doing those things. Due diligence was virtually non-existent in this crypto bull market of 2020 and in 2021. Due diligence in this space, not just with FTX, but if you just see the contagion exposure everywhere with Voyager and Celsius and Gemini and FTX, Babel Finance that went down, all of these other institutions, hardly any of them performed proper due diligence. If you see what happened with Three Arrows Capital, they utterly collapsed because they had been given a bunch of unbacked and under-collateralized loans from different people in the space. And it turns out many of them were lending to Three Arrows Capital simply based on their reputation. So it goes, well, so-and-so already lent to them, so we must lend to them. And it just becomes turtles all the way down, an infinite regress of under-collateralized leverage. And what you end up with is an extremely fragile bubble that is propped up by popsicle sticks and vapor and is not remotely representative of the actual capital allocated to the space. So we got a massive crypto asset bubble, driven in part by monetary policy and fiscal spending, which created a bunch of distortion in the markets. We know that. However, the people in the space who are supposed to responsibly allocate capital, the investors who are supposed to know what they're doing, they clearly are capable of the same kind of giddy fanboy reactions as the average retail investor is. So there's a lot of growing up that needs to happen in this space before we can actually move forward and be taken seriously. This will take years to recover from. And the way that this was done, with CZ announcing publicly that he would buy them out, which allowed the public to then be exposed to all of FTX's dark secrets, all of the corpses that they were hiding, for them to look at all of that, for it to be brought into the light, only for CZ to turn around and walk away, is the worst outcome for the industry. Because if you think about it, FTX and Sam Bankman-Fried, they were paragons of the industry. They were considered to be one of the good guys, one of the best guys. And if you drag them into the spotlight and everyone sees that they were wearing no clothes, that they were operating with hubris and irresponsibility, recklessly investing customer funds to a point where they were not able to service their withdrawals, and then before buying them out and rescuing those customers and propping up the industry, you then decide to just walk away after we've all seen how bad it is, it's the best outcome for CZ personally, because he doesn't have to spend money on a bankrupt enterprise, and he gets to retain his dominance. He gets to naturally absorb the market share from the failure of a major rival. But the optics for this industry, particularly for normie observers, are very bad. This will take years to recover from. This is probably exponentially worse than the Mt. Gox failure. The industry is much larger, the wealth destruction is exponentially larger, and the stakes are higher. So there was just an abhorrent lack of proper diligence paid, and it became rampant among a nucleus of hedge funds that essentially became slush funds. And these proceedings with FTX take on a different light when you think about how Sam Trabucco, which was the former head of Alameda Research, left in August. He ducked out months ago, and he must have known that these things were coming. It was here on August 24th that he announced he was stepping down from Alameda Research. And then just yesterday he tweets out, "I'm sure the past few days have been dark for many, and I hope the road ahead is brighter." This was on November 8th, 2 days ago. He had to know that the balance sheet of FTX and Alameda was in utter despair, and he got out before any of this was adhered to him personally. So in hindsight, him leaving Alameda was probably a signal that something was not right under the hood, and we're now seeing that with the benefit of hindsight. But after the news yesterday, as soon as it came out that FTX was going down, all of crypto also went down. Bitcoin quickly broke through these lows, shattered through the 2017 high, and fell all the way down to the middle 15,000s. And if we zoom out on Bitcoin and we try to look for places where we might see some resistance, there really isn't very much until you get down into this area here around $12,000, $13,000, which is basically the 2019 highs. See these consistent candles here just going straight up? This is what you'd call a fair value gap in a way. A lot of times a fair value gap is a single candle, but it could work in this instance because it was just a straight line upward with zero consolidation, no friction whatsoever. So this becomes kind of a vacuum for price, and it makes it more likely that price is going to drift its way down into this area. So that's currently my base case, but it doesn't mean it will go there linearly. We're already seeing a pump today day. Bitcoin is up 11%. Most of the crypto space is up. I mean, just look at all the green over here. Most of these things are up 10, 15, 20%. This is a violent bounce in a thin market, as we touched on earlier in the video. So that's why I don't get really carried away when I see these pumps. I know there's people trading them on lower time frames, and they're probably making a killing. But on a bigger picture scale, if I'm looking at directionality of the market, my base case is that prices will make their way down here. We've taken that approach to this market this entire year, and we've called it pretty accurately. So I don't see a reason to deviate now. I will maintain my approach and say that regardless of short-term action and fluctuation, I think price is destined to come down to this level, mostly because this is basically a vacuum. Also yesterday, Solana got utterly torched. This is one of the babies of Sam Bankman-Fried. They're basically in bed with FTX, and they were getting crushed yesterday because Solana is one of the biggest assets owned by Alameda, as we discussed yesterday. So it has been pulverized into the pavement. And yesterday, the low on Solana was below $12, which took it all the way back to February prices of last year, 2021. There's a bunch of other tickers that look like this. AVAX broke through the June lows, but it doesn't look quite so low. Many others just look like shit. FTT is essentially dead, as you would expect, being the token that is native to the exchange that just went under. I don't know if FTT is used on FTX US. I don't think that it is. I don't personally care if it is, because this token is worthless. And I think that tokens like this, exchange-related tokens, will be made illegal in the very near future as a result of this fallout. There is no American policymaker that's going to tolerate another exchange creating their own token to steal from customers. Essentially a worthless artifact that is meant solely to provide liquidity within the ecosystem. I don't think that these instruments are long for this world. Another development I've been watching this morning is the stress that Tether is under. So this is a weekly chart of Tether going all the way back to 2017. This morning, Tether is down at around 99.5 cents. Now, if I zoom in on this a little bit and we look at it on a 2-hour time frame, Tether has been in a decline. Look at this. Now, pay attention to the axis. This is 99 cents. So this whole move right here is a single penny. But this matters because it is a stable coin that is supposed to be exactly $1 all the time. But basically, since the middle of November 8th, 2 days ago, when this whole saga began, Tether has been experiencing pressure. It's been under duress, and we saw a huge wick down as there were probably a lot of redemptions, maybe someone trying to short Tether and create more volatility. It has bounced back up. That's good. It's back up over 99.5 cents. But just big picture though, if I go pull my chart back up here, I got to zoom in to fix this axis. This is a weekly chart. Look at where it is. Let me put my red line where the price is. It's below essentially all of the price action back to this moment here in the middle of 2019. So this is a big moment for Tether. There's a lot of people who dismiss Tether FUD because Tether has survived all the bear markets. They've always made every claim on redemption. They so far have not failed. They may have questionable books. We may not like the owner. We may not like the way they do business. However, they have remained and they've remained steadfast. But when we see this kind of pressure, sustained pressure on a multi-day time frame, and it's well below the duress that they've experienced at any point this year, that is concerning, and I think it's something that we should be paying attention to. I'm not on here telling you guys I think Tether is going to collapse or fail or anything like that, but I think it's realistic when we look at the price chart. I mean, simply just look at the chart. It's doing things it rarely ever does, except in periods of severe stress. Only now, the market cap is considerably larger than it used to be. Let me just pull up the market cap of Tether so we can look at this. Back here in 2019, the market cap of Tether was a couple $billion, $1 to $2 billion. Over here, the market cap is $68 billion. So it is 34 times the size that it was the last time it experienced this duress. So I do think this is a major development. And man, a lot of these clients are just screwed. And I hate to see this for people. People trust these businesses. They put their money on this exchange and they expect it to be there. There's a very public person at the head of this company. He's out there saying great things about the crypto space. It seems like someone that everyone is trusting. And so people feel comfortable giving him their money. And it turns out that he was a snake in the grass like all of these other clowns. And he was not deserving of our trust. And if we've learned anything thing going forward. It's that we should not be too hasty in assigning hero status to any of these remaining players just because they're still standing. They haven't been taken down yet. We don't know nearly enough about the finances of Binance to be able to anoint them as any kind of paragon. Time and time and time again, the heroes of this space have been dismantled and dethroned in the least graceful way possible. All of these firms that have been taken down were doing irresponsible shit with customer funds. Every single one of these yield protocols, all of these lending platforms, none of them are to be trusted. And many of these people will simply not get their money back. It's crazy too, because this hole right here, this $8 billion hole is massive. If you think about the fact that SBF has like an 8% stake in Robinhood, and then you consider that the Robinhood market cap is essentially the size of the hole in the FTX balance sheet, it gives you a sense of the scale of the problem that exchange is facing. FTX, not Robinhood. They may have their own issues, but currently their market cap is $8 billion. And that is exactly how much Sam Bankman-Fried is missing out of his customers' accounts. So this is a massive hole, and it's probably much bigger than $8 billion if I had to guess. So we've got this volatile price action. You can see on my Sigma indicator down here, we've had multiple multi-Sigma days. Very unusual, even for an asset such as Bitcoin. And I think that the failure of the June lows have essentially sealed our fate in ultimately traversing back down into this area here in the middle teens and threatening the $12,000 to $13,000 range. It may go lower at that point. I don't know. We'll take it as it comes and analyze it once we get there. But from a structure perspective, this is a vacuum. There is open air here, and I don't see any reason why price won't drift down into this 12 to 13,000 range at some point in the future, especially with the tried and true habit of Bitcoin always testing its lower wicks. Every time. It retests every level at least one more time. It's done that over and over this year. Every single time we create a little wick, we eventually come back down and we take it out. Now, the one thing working in the favor of this not having that happen is that this isn't really a capitulation wick. This is a full body candle. But that could also be interpreted bearishly because this doesn't look like a technical move downward. This looks like people actually selling. This looks like a complete lack of bid. So that's not a trend I'd like to see more of, where we have these thick-bodied candles on the way down to 12,000. So I remain very cautious, on high alert for these markets. And it's important to remember that these markets are highly predatory. We've talked about the thinness of books in a bear market before, and it is a fact that you must keep in mind. When there are fewer people in the market, as we have now, there is a lot of capital that has been withdrawn. There's a lot of wealth that has been destroyed, a lot of sentiment that has been dampened, and people are simply not transacting at the scale and eagerness that they were months ago. So as the books thin out, there's fewer and fewer elements of friction to slow down the movement of price in a given direction. It's like standing in a pool of water that isn't deep enough to slow you down as you run. In a thick market, that water is above your waist. And as you try to run forward, there's pressure pushing back against you, and it takes much more effort to get price to move in the direction you want. But when the books thin out, that water level falls, goes down to your ankles, and then there's far less resistance in your ability to move in either direction. So that's what's going on with the markets, and that's why you get these huge candles, these 4% green candles on the S&P following a catastrophic market day in terms of news and sentiment. So this is a highly predatory market. You've got the futures. They were up 3% before the bell even rang on wafer thin book depth. We've got a bunch of people in the industry that are down cosmically because of the fuckery with FTX. Many people who will be trying to make back their losses as quickly as possible. That's the kind of environment where you must keep your head on a swivel and be aware of the intent of other participants. The trend is currently down to sideways sideways. Big choppy moves like this will sucker in bulls, particularly if this breaks above this level right here. If we break above this resistance area that I have drawn, let me maximize my chart. If we get above this little area right here, this little pivot of resistance, we break above this spot, people are going to buy. They're going to buy right here, and they're going to get trapped if price makes its way back up here and rolls over, as it is very likely to do if it actually traverses this distance. Let us not forget that the 200-day moving average is just above price. It's actually right up here at this resistance level. Thin liquidity and a volatile market could quickly send us up here in a matter of just a few days, and then we could roll over as we find ourselves at legitimate technical resistance. That's what has happened throughout this year as we have introduced ourselves to the 200-day multiple times. So we've got the collapse of FTX. We've got the buyout backout from CZ, resulting in what I believe is the worst outcome for this industry. You exposed a paragon and all of its dirty secrets to the public, and then you walked away without rescuing them, leaving their customers stranded and the industry in despair. This will take months and years to recover from with the general public. Regulation is coming in a tidal wave as a result of these events. They were already catalyzed by what happened with Luna and 3AC earlier this year. The failure of a very public entity like FTX that was very friendly with lawmakers is bound to bring down the hammer. We've got many participants in this crypto market who have lost their wealth, who trusted FTX not to disappear overnight, who woke up without any funds in their account. There are people hurting today. I encourage you to reach out to your friends in this space. Give them a helping word. Make sure that they're doing okay, because these are the kinds of times where people make rash decisions. And there's a lot of distortion because of the thin books, because of all the volatility, because of what the central banks are doing with monetary policy, because of the possible impending global recession. There's a ton of volatility and risk in this market, yet we can still create these huge green days that are both confusing and bewildering considering the events of this week. But even with all this volatility, even with all this drama and these unprecedented conditions, there are still aspects of this bear market that resemble those of the past and haven't yet created some new story, some new history. Here's a look at that. This is all of the Bitcoin bear markets, all four of them, marked from the high of price to the low of price. Now, this is the 2011 bear market here in gold. This one was kind of an anomaly. The market was very small. It was almost entirely peer-to-peer, and it's hard to make comparisons to this one. But moving forward in time, this is the 2013 to 14 market. It lasted about 400 days, 406 days, with a deep drawdown of 84% before price turned around. In 2017 and 18, the market went exactly 365 days from the top to the bottom, and we saw an 83% drawdown, just slightly better. Now, these are daily closes, by the way. If you look at a chart on TradingView, you might see a wick that goes lower than one of these percentages. That's not concerning to me. I'm using daily closes. But the thing to really draw your attention to is this bear market. This marks from the high in November. We are currently on day 367. This is as of yesterday. So we're on day 368 of this bear market. We are at a 76% drawdown as of yesterday. And if you look at where this market compares to both 2017-18 and 2013-14, we're right in the ballpark. We've been following it really closely, particularly this stretch right here. This is the dead market phase that everyone talks about in this space, where you go into just zero volatility. Everything goes sideways. No one gives a shit. We're in that phase now. Now, we did just get a flush, like we had a flush in 2018, like we had a flush here in 2014. So this fractal is playing out in similar ways to the prior bear markets, even though we know that the outside conditions surrounding Bitcoin are quite different than they've been in the past. I do think that within a month or two, this line will then be out here. It will be telling its own story. But for now, you can see that we are still living a cycle that is similar to the past. We may not get to hold on to that narrative for very much longer, but for now, it is still intact. And I just love this chart. But But let's dig in a little more on where the volatility came from today, how we ended up with these big green candles today, and they have to do with the CPI report. So we've been expecting this CPI report, and we talked about in the video yesterday that Inflation Nowcast was expecting CPI to come in around 8%. Well, it came in at 7.7%. It surprised to the downside, and thus the market is ripping. Now, this is just one print. The Fed wants to see a multi-month series of lower prints. So CPI came in slightly lower, and there were a couple of pieces inside of it that got the market excited. One of those is used vehicles. This is one of the more watched components of CPI. It has been getting more favorable over the last 3 months of month-on-month changes, which is what we're looking at here. Month-over-month used vehicles have been getting more and more favorable on pulling CPI down. You can see across the basket, many of these things that were providing gains have remained relatively flat or have slightly improved, as you can see with new vehicles. However, energy has been bouncing around a lot. It's very volatile, we know that, but it's gone from being a net drag on CPI to now lifting CPI. It's up 1.8% this month. And part of that is because fuel oil is up 20% in 1 month. That's fucking crazy. Fuel oil is commonly used in New England, up in the northeastern part of the US, and they're entering a cold part of the year. So I really hope that this does not squeeze New England too hard by these volatile fuel oil prices. Oh my God, 20%. So we still see broad lifts in CPI, including a rise in energy. Airline fares, they're still a little bit lower. Apparel coming down a bit. Medical care services falling a bit. Used vehicles falling, and many of these others remaining in relative stasis. So this is a positive CPI report relative to this year. It's not a good CPI report. It's 7.7%. That's terrible. That's unsustainable, but it's an improvement. And for those reasons, in conjunction with the thin books that I've been preaching to you guys about in this whole video, we end up with this big candle. So don't read too much into this, though it could catalyze a multi-day move if the positioning is favorable. There's a huge put to call ratio right now in the S&P that might be helping to contribute to an upside move. We'll have to see how the rest of the week plays out. And as I sit here trying to edit my video, I saw this news drop that FTX, according to the Wall Street Journal, had $16 billion in customer assets, which, if you consider the $8 billion hole in their balance sheet, means that they lent half of customer funds to Alameda Research. Customer deposits. That is a goddamn catastrophe. This is a nightmare. And just as we suspected, that $8 billion turned into double digits extremely quickly. And then, to top it all off, as we looked at Tether just a few moments ago, Tether has begun to freeze assets at the request of law enforcement. I'm telling you guys, this whole saga is bigger than Mt. Gox. This is the worst scandal in the history of crypto, and we've barely begun to scratch the surface. More bodies will float to the surface. Be ready for it. So that is what's going on in the markets today, guys. We may get some more news around the FTX unwind today that we'll talk about in the next video, but it was important to me to make a summary of the events of the last couple of days, because I truly believe that this event will go down as one of the worst days in crypto history. I've only been in the crypto space for about 1.5 to 2 years, but I can already tell this is probably the worst event in the history of the space, both in the scale, in the reputation, in the stakes. It's massive, and it was important to me that we get together and we walk through the sequence of events. So I appreciate you guys hanging out with me today, even if this video jumped around a bit. Make sure that you follow me here on Twitter at TXMC Trades. This is where I post a lot of my intraday analysis that I then collect together and turn into these videos. I also recommend you guys check out my newsletter. Maybe you're sick of hearing about it, but I'm going to mention it to you at the end of each of my videos because this is my attempt to turn this into a career. Every single dollar of proceeds from my newsletter goes directly to me. No one else gets a cut. And this is where I put a lot of my longer form ideas and research, and I share my interactive charts with subscribers. So check out the link in the description to this video, or go to Twitter and look at my pinned tweet. But either way, we'll keep making videos on this channel together, watching the markets, observing them as they unfold, and trying to navigate through the murk. I hope this video makes sense. I feel like I rambled for an hour, and I don't know what it's going to look like when I get into editing, but I've said that before and the videos turned out okay. So maybe I shouldn't worry. But that's it. I've rambled. You guys have listened. I appreciate you. I thank you so much. I hope that you're doing well and that you're taking care of yourselves in this very tumultuous market environment. Make sure that you reach out to other friends that you have in the space. As I mentioned earlier, people are suffering right now. This is the kind of time where folks really need the support of others who know what they're going through. We will make it through this. This will not be the end of crypto, but it could take us a couple of years to truly recover and move on from the events of this year. They've been catastrophic, and we have a lot of lessons to learn. So with that said, I will let you go. We will talk again in the very near future. I don't know that it will be tomorrow, but I'll try to make a video soon. Continue taking care of yourselves. Also take care of your friends and loved ones. Lean into your support networks and make sure you get some fresh air. We will chat again in a few days. Cheers, everyone.